For those who don't know me, my name is Caroline Stevenson, and I'm a partner in Burness Paul, specialising in financial services regulation, and I'm delighted to host you today on this. I'm going to be joined by four fabulous speakers who you can see on screen at the moment, but I'm going to keep them on mute for a little bit longer, and they will each introduce themselves before they start their segment. There's quite a lot to go through, so we're going to do a bit of jumping about to keep it fresh. So today's session is on horizon scanning, which is a topic that I'm sure is something that you are loving at the moment because there's so much to keep on track of. So today we're going to specifically talk about the regulatory initiatives grid. I'm sure you're all very familiar with this and it's often hotly anticipated, but if it's your first time here, then the regulatory initiatives grid is a biannual sort of gift from the regulators. We got this one just in time for Christmas, and effectively the grid sets out what they plan to focus on for the next year. And the grid itself isn't just pulled together by the FCA, it's pulled together by the Financial Services Regulatory Initiatives Forum. And that's a forum which was launched a number of years ago to try and strengthen coordination between various members and regulators. And so it's made up of representatives of the Bank of England, the CMA, FCA, the Financial Reporting Council, Treasury's there as an observer, the ICO, Payment Systems Regulator, the PRA, and the Pensions Regulator. And the forum is actually chaired by the FCA and the PRA. They sort of co-chairs on this to sort of keep everybody in order. So given the attendees at the forum, the grid is really usually a comprehensive list of any sort of planned interventions or areas of focus of the regulators combined for that following year. But this year, unfortunately, we don't have a comprehensive version of the grid as it only focuses on 2 quarters, which is Q4 2024, which obviously is what we're currently in, and Q1 2025, so what we're expecting at the first part of next year. And so you might ask, why? Where's the rest of 2025? Well, the FCA noted when they published the grid that they're unable to commit to the initiatives for the rest of the year due to the delays caused by the general election, because obviously quite a lot of sort of regulation stems from what the politics is at that time. So we're kind of left with both a sort of delayed and a shorter version of the grid. But the good news is we will maybe be gifted with another version of it early next year, so we can get a bit more understanding of what else we're expecting to come down the track next year. So anyway, before the rest of us get into the grid, I wanted to remind you that this is not going to cover everything that's on your regulatory horizon. There is so many things on the go at the moment and so many different developments already in train that I'm sure your risk teams are all over. But there's a couple of them that doesn't make the grid, but we thought it would be useful just to highlight because they're quite exciting initiatives or sort of updates that's happening in the industry at the moment. And one of those, which is one that I've been looking at very closely along with Jake and the team, is the monumental Court of Appeal case on Car Finance Commission, which sent shivers down the spine of many a lender or sort of car dealer. But actually, once everybody took a breath and actually read what the judgment said in those cases, it really sent shivers down the industry as a whole. If you haven't heard it, it's definitely worth a read, but we've actually got a briefing on it on our website, so you can find out more. But effectively, these cases go beyond anything that you'd expect in terms of being sort of revealing levels of commission, and basically it's got this. We've now got this risk that anything that's been included in your terms and conditions or buried in your terms and conditions that hasn't been brought to the attention of your customer could suddenly be deemed to be unenforceable or unfair. And so we're expecting these judgments to go to the Supreme Court. But until then, there's a lot of uncertainty in the market, and we know that there's some particular lenders that's absolutely pulled out. They're just too afraid to sort of continue going down this track until there's a bit more clarity on what the expectations are by the regulator and the court. So that's a really exciting one to watch. Another one that has been recently launched that we're not going to cover today, but it's worth mentioning, is something that Jamie's really excited about, which is PISES. If you haven't heard about PISES, it is the Private Intermittent Securities and Capital Exchange. And that was mentioned most recently in the Chancellor's Mansion House speech last week. So PISCES is going to operate as an exciting new development. It will be a secondary market for trading existing shares in any public or private company that's not already admitted to it as a public market in the UK or abroad. So they're about to launch the trial of this, and it's going to be within a sandbox at the initial stage, and it's going to be quite restricted in terms of who can undertake the trading whilst it's in the sandbox. But we should see lots of developments and sort of communications coming out about how this working. It is expected that the sandbox will be about 5 years, so they can test the regulatory framework and make sure that it's a safe space to do that type of trading. But if you've got any questions on that, then reach out to Jamie, because it's something that he's following closely, and it's definitely exciting for the private shares market. So those are two exciting developments, and those are two of many. There's so much that the FCA has been doing recently. It was definitely worth checking out their website. But we, as I said, we're going to go straight on to the initiatives grid. The good news is we are not going to cover everything, because there's 70 different initiatives listed on the grid, which is quite staggering, considering it only really covers 2 quarters. And so, as usual, we've set out the grid. Hopefully you can see that on the screen okay, by quarter. And so the first quarter here is quarter 4, 2024. When we go on to the grid pages, the ones in red are sort of the ones that we personally find exciting, and the ones that we're going to cover today. So without further ado, we'll go into the grid and we'll take you through some of the things that you can expect in the next 6 months or so. And you don't even get rid of me yet, because the first thing I am going to cover, which is the oversight of critical third parties and sort of incident and outsourcing and third party reporting. And now I've spoken to you a few times about critical third parties and the regime that we're expecting about this. Oh, gone too quick there. But finally, we've got a bit more detail. We've actually got rules on what this is going to look like, because the regulators have been pretty busy earlier this month, and we've seen supervisory statements, policy statements, approach documents. We've had updated versions of rules under this regime. So we now have got clarity of what actually this is going to look like for those critical third parties. The first thing is sort of the bad news, and that is that in this new regime is going to take effect from the 1st of January 2025. So what, 6 weeks away? I think the good news about this is that they are only going to apply to you as a critical third party once you've been designated as such by the Treasury. And the Treasury at this stage are saying that it's likely going to take further 6 months for them to sort of complete that initial designation process. So what is a critical third party? Well, the Treasury have clarified that they may designate a supplier to financial services as a critical third party if they are satisfied that a failure in or disruption to the provision of its services could threaten the stability of and confidence in the UK financial system. So you've got to be quite important, I think, to be designated as this. But if you are designated, what does that mean? Well, the overall objective of the scheme is to manage the stability and confidence in the UK financial system. And it's all about safeguarding against failure or disruption to the services. And so beyond that sort of objective about this sort of safety mechanism, the scheme is going to be made up of a bunch of fundamental rules, which should be familiar to you as a regulated entity, because they are very much like the FCA principles of business. So the fundamental rules under the scheme will include requirements like acting with integrity, conduct business with skill, care, and to be open and cooperate freely with the regulators. So that things that are all familiar to you, but it's not going to be familiar to these sort of third parties, unregulated suppliers. The interesting part is that the Treasury has taken it upon itself to be able to designate anyone in the world, wherever situated, as a critical third party. So I think this UK-based regulation will have really far-reaching effects. This means that wherever a supplier may be based, if they're deemed critical, they may have to put in measures to sort of update their contracts, their processes, their business as usual, to make sure that all of this complies with the requirements of the critical third party regime. And the rules themselves within that regime are split into sort of three main categories. There's sort of operational risk and resilience requirements, self-assessments, scenario testing, incident management, sort of playbooks, exercises, sort of testing, making sure that your systems are secure and that they are robust. And also the good one that the FCA always loves, which is incident reporting and notification. I think this might be ringing familiar chimes to some of you because we're doing a lot of this already in the industry. If you're in the process of or have recently implemented DORA, which is the European Digital Operational Resilience Act, then some of these common themes you can see are emerging. It's all about risk management and how you as a firm rely on the integrity of supplier and how that can really impact your sort of service to your customers. So it's definitely a theme that we're seeing more of, and we are going to be seeing more of in the future. We're likely to get a DORA that's a similar DORA that's onshore to UK. But beyond that, you can see one of the other red topics here is the incident and outsourcing and third-party reporting consultation. This is just another step in that theme to sort of protecting the integrity of supply chain. And so we're expecting to see a new consultation that's going to look into sort of outsourcing and third-party data collection. Anyway, there's lots going on in that space, but it's just one small sort of subset of what the FCA and the other regulators are swirling away doing. So that's probably enough for me just now. I'm going to pass on to Jamie, who's going to talk about something potentially more interesting.
Thanks, Kat, and great plug on Pisces. I appreciate it. So yes, I'm Jamie Gray. I'm a partner in the team with a special focus on banking, payments, investments, funds, and cross-sector stuff like ESG and crypto. And my first topic today is the remuneration review, which we've got in that first column. It's a new remuneration review consultation paper, which we're anticipating will be published by the end of this year. And that information in the box is about as much information as we have. So next topic. No, I think there's a little bit more text, and if you'll indulge me, it's probably useful to try and unpick, engage in some speculation as to what that review might cover, because I think it's good to anticipate that based on previous similar consultations as well. So what we do know is that it's a joint initiative led by the PRA and the FCA, and the aim is to reassess the current remuneration framework, which is made up of EU legislation, domestic law, and FCA and PRA rules. And the way the rules apply varies depending on what kind of regulated entity you are and which sector you're in. We know that the changes follow on from previous changes made in October and December last year. That was the removal of the bonus cap and changes to proportionality for smaller firms. And interestingly, that initiative was one of the lasting proposals announced in the mini budget, and one that was actually generally well received, so it's still here. And that background is important. I think overall, the aim behind removing the bonus cap was that it should make the whole remuneration framework more effective at achieving its goals of aligning incentives. Increasing that slice of compensation at risk, the variable component relative to the fixed part of compensation, means that more of one's pay would be subject to the incentive setting tools that are in the remuneration framework. And that flexibility should better equip firms to absorb losses during downturns or respond to poor performance or misconduct, and indeed it incentivize the right behaviors, which we'll come on to. Something else to mention from what we've seen in the grid is, in the text, is that the PRA and the FCA are aiming to make the changes in this review in line with both their primary and their secondary objectives. A lot's been said recently on the need for regulatory bodies, particularly the FCA, to support economic growth and competitiveness. Previously, the secondary objective has been just that, secondary. And Chancellor Reeves highlighted that post the financial crisis in 2008, financial regulation has overstepped the mark and gone too far, which is hindering growth. There's clearly a governmental push towards regulatory reforms, and I think the FCA has faced some criticism for the complexity and extent of its rulebook, which I think is over 10,000 pages long, which may possibly be hindering competition. So this nod to the secondary objective in that brief blurb, in my view, is at least an acknowledgement that what changes come will be simplifying existing rules. Other factors that could influence the new review could be diversity and inclusion, perhaps even wider ESG, and the recent announcement of the certification regime consultation on reforming that. On D&I, there is a separate highlighted part of this slide, diversity, inclusion and financial services. There was a discussion paper on D&I in the financial sector in 2021, and then a consultation paper last year, which among other things raised the prospect of linking remuneration to non-financial metrics like D&I. At that time, the FCA decided not to go ahead and make changes, but they committed to revisiting it at the next suitable opportunity, which leaves the door ajar for it to feature in this review. It seems like an obvious time to reconsider. The PRA has also discussed embedding D&I objectives into performance scorecards, so it's clearly a topic of interest for both regulators. On a side note, I don't think it's on that particular slide, but we are expecting a policy statement on tackling non-financial misconduct around year end to be followed up by FCA and PRA policy statements on the remaining D&I proposals in 2025. So there's a lot going on in this space. On top of D&I, why could SMCR be relevant to remuneration? Well, in the Mansion House speech, the Chancellor announced a commitment to consult on replacing the certification regime with something that's more proportionate. It's possible that that too can intersect with remuneration reform. So if and when individual accountability framework reform does arrive, firms could be required to align individual performance objectives with broader cultural or strategic goals, including D&I. So key things to watch are the secondary growth and competitiveness objective, policy lever and lighter touch proportionality approach, possibly including D&I metrics to link remuneration with perhaps wider ESG targets, and possible updates resulting from the certification regime reform. So that's remuneration review, and I think I hand you over to Lindsay.
Great, thank you. So my name's Lindsay Whelan. I'm a senior associate in the Financial Services Regulatory team, and I have particular interest areas which include pensions, platforms, insurance and advice. So I'm particularly interested and excited about the topics I'm going to cover today. So the first one relates to the pensions dashboard. So that's included for the Q4 2024 updates. We actually have that now already. So the policy statement was issued on the 7th of November, so just a couple of weeks ago, and that follows the consultation paper from 2 years ago in December 2022 and a further consultation in February 2024. So just firstly, by way of kind of very brief background, the pensions dashboard proposition overall is the idea that savers will be able to log into a dashboard and be able to have a full picture of all their pensions for the first time, rather than being kind of provider specific. So hopefully it will give people kind of better visibility and maybe even information about pensions that they had forgotten about. I would caution, although we've had the policy statement, the launch of the kind of private sector dashboard is still some way off. So it is progress, it is one step forward, but we're not there yet. So initially the connection for the dashboards will still be through the Money and Pension Service, and that connection is starting, it's phased and will start from April 2025. But turning to the kind of private providers, the FCA will regulate these firms that operate the pension dashboard services. So firms wanting to enter this space will need the regulatory permission, or firms that are currently authorised will need a variation. I guess the kind of areas of focus are that investors will be potentially able to see access to a lot more of their money that they kind of may have forgotten about, which will be a really good thing, but we'll need to be careful in terms of how that money is then managed. And that's really the main reason that the FCA, or one of the main reasons that the FCA will be authorising them. It'll probably come as no surprise through the consultation paper and the policy statement that the rules focus on consumer protection and consumer understanding. They do apply a lot of the key kind of existing elements of the handbook, so no huge surprises there. There is, however, a kind of specific chapter which will relate to pension dashboard providers, and some of those rules were considered to kind of be too prescriptive and quite restrictive for those providers. But I think from the FCA's perspective, they've kind of largely kept with it, noting that it's a kind of new area and ensuring that consumer confidence is high is one of their top priorities. It ties in a little bit in terms of consumer protection to what I'm going to come on to with the advice guidance boundary review and mass market support. So kind of some similar principles and objectives there. And I kind of mentioned earlier, sort of, we're not kind of ready to go yet on the pensions or the private pensions dashboard, albeit we've got the policy statement. So the gateway for the applications won't open until the government and the pensions dashboard programme have produced all the kind of information necessary for a firm to actually design and build the service. So we will be waiting for that. So I think kind of overall steady progress in the right direction for private pension dashboard providers, but a bit of work still to do. So I'm going to go on now to the advice guidance boundary review, which doesn't roll off the tongue. The acronym's not much better, but there we are. So overall, very excited about this one. The whole point of this part of the review is to try and address an increasing problem that I think overall everyone's been sort of known as existed. It's got worse and we've not done a huge amount about it. So is really trying to tackle the advice gap, which has got bigger kind of post the retail distribution review in 2012. And although Consumer Duties brought a lot of positives and benefits for the industry, it probably has exacerbated the advice gap. So just as a reminder, we're basically talking about everybody who has got kind of too much cash to just be sitting as cash in a savings account, but not got enough money to start being able to access advice. We've spoken to some advisors recently who are kind of setting that threshold around the sort of 200k and above mark. So very difficult for people with a significant enough amount of money, but just not enough to access advice. And so that's really the whole point of the advice guidance boundary review. And so the FCA on the 15th of November, so this is another one where there's already been progress through Q4 2024. So last week the FCA published a statement with feedback from discussion paper in 2023, and it sets out the next steps. So various options have been considered to try and address the advice gap. Those are kind of separated into three, which was targeted support, simplified advice, and clarifying the boundary of when it would be considered to be sort of straying into advice. So I think advisors have of late been very focused on their sort of high net worth clients and, you know, all the detail that supports the personal recommendations. On the provider side, they probably tried to stay very far away from providing advice and, you know, servicing accounts, providing factual information, but not overstepping that. And so some way we need to get either movement from the advisor side, hopefully, to try to offer some of these. And there are some providers who are thinking about offerings on the basis that they would be able to deliver some kind of subset of advice or support and be able to do it at scale. So in terms of what's coming, the statement has set that out. So the first consultation will be in relation to pension support. So that ties in a little bit with what's happening with the pensions dashboard. So I think the focus there is that, you know, there will be a lot of people who are suddenly able to see a whole picture of their pensions and will need support as to what they're going to do with that money. Do they take it? Do they access it? Do they consolidate it, etc.? So that's going to be the first focus, and in terms of how the targeted support will work for pension savers. But relatively quickly, by the end of H1 next year, the FCA will develop related proposals for targeted support to wider investments. So I think the area of focus definitely seems to be targeted support rather than simplified advice. I think over the last few months, there's certainly been a lot of headlines suggesting that simplified advice is now completely off the table. That doesn't seem to be the case from what the FCA have said in their statement. So they are still planning to engage with small advice firms through 2025 through a series of round tables to try and gauge the willingness and capacity of these firms to offer simplified advice. So it'll be interesting to see what comes out of that. I guess if they get enough sort of interest in it, it's something that might progress, and otherwise we might see it really sort of stopping or being pushed more down the sort of targeted support route. So just one or two other points to flag is that the propositions for anybody looking to offer targeted support can be tested in the digital sandbox. I think Caroline touched on that earlier, and it's definitely an area that the FCA are trying to encourage. So we saw it recently with market abuse and firms being able to test processes and systems there with real data that had been anonymized, and it's also being used in relation to AI. So there's a timetable there which just shows like the work in progress that's happening there, and hopefully quite a lot of movement once the FCA have kind of concluded this next part of the engagement and consultation. I think I'm now handing back to Jamie.
Perfect. Yes, so on to ESG ratings regulation. It's Q4, but it's also next year as well. This is another hot topic that could significantly impact those who rely on or provide ESG ratings and data. It's something that the Treasury consulted on in 2023, and update to the grid is that last week it laid out the future UK regulatory regime on this. The plans are generally being driven by, well, twofold, helping the UK meet its ESG objectives and contributing to a better working world, but also the global ESG market is influencing billions of pounds of investment. I think it's predicted to surpass, according to the Treasury, 40 trillion by 2030, and investors are increasingly using ESG ratings to inform investment decisions and allocate capital. The aim of this framework is to ensure transparency and reduce conflicts of interest in line with IOSCO's 2021 recommendations. And the goal then would be to boost investor confidence and reduce greenwashing risk. Next year, early next year, legislation is set and full implementation is expected within 4 years. That's going to apply to UK-based and overseas ESG ratings providers as well, where they're engaging with UK users. Just briefly, how's it going to work? There's going to be a new authorization regime for ESG ratings providers, so a new regulated activity in the regulated activities order. The Treasury has said that the FCA rules will likely focus on transparency, governance, conflicts of interest, and having robust systems and controls. There is this draft statutory instrument that's now open for technical comments, but I think the overall thrust of the regulatory perimeter and exclusions are, as have been set. There are other elements like transitional provisions, consequential amendments, and market access routes for overseas providers that are still works in progress. I think a key thing that I take away from it is the focus is on the definitions of ESG ratings, as any discussion on ESG often gets into the weeds or the treacle of what is and isn't ESG. But here the focus will be on whether there's an ESG opinion or an ESG score or both. And opinion is, as you might expect, something that requires substantial analytical input from an analyst, whereas a score is something that's derived algorithmically without that analytical input. And there are quite a few exclusions that would, I'm sure, in due course be analysed to the nth degree. Two worth drawing out are ratings for internal use and bespoke solicited private ratings that they're carved out, but there are some other likely useful exclusions in there too. So all in all, it's expected to take around 4 years, and there is time to prepare, but I suppose it's just important to keep an eye on what the Treasury and the FCA's plans are for those UK and overseas providers. I'll hand you back to Caroline.
Thanks, Jamie. So now we're finally made it to Q1 next year, and I'm going to touch on the one at the top left under January there, the external redress guidance. There isn't much to say in this one, but it's interesting nonetheless. I think this one has really come about on the back of the way that the Consumer Duty was implemented, because as you might know, under Consumer Duty, a number of firms, when they were doing their reviews and implementing their plans, they might have felt that historic processes or the way that products were sort of featured, the value that they had was maybe didn't meet the requirements of the duty, and we did see quite a lot of adjustments being made to products. So under this new external redress initiative, the FCA they're undertaking a review of the rules and guidance that's available to firms when they're identifying harm and conducting their own redress exercises. So we should be seeing the FCA publish a consultation which would set out their expectations of firms when they're identifying and conducting these sort of firm-led redress exercises. And that consultation and process will likely cover identification and reporting of harm, things like the guidance on how firms should be rectifying harm, and sort of how to undertake proactive redress exercises. So hopefully, once this has been consulted on and the rule changes, hopefully we can get a sort of more defined structure around how firms should do this, which would hopefully stop the FCA then jumping in from time to time and saying, firms, you're not doing it good enough, you must have a skilled person appointed to help you with this exercise. So hopefully good news for firms, but a bit to go until we get clarity on that. That's all on me. I'm going to hand over to a fresh speaker now, which is Lorna.
Thanks, Caroline. So as a quick introduction, my name is Lorna Stephen, and I'm an associate here in the FS Reg team at Burness Paull. And the first topic I'm going to discuss today is just below the one Caroline's mentioned. It's the regulation of the commercial insurance market. And I am conscious of time, so I'll try and keep this brief. But this was a discussion paper that was actually issued in July 2024. And it was initially closed on the 16th of September. However, some of the questions have been reopened earlier this month. So the first point the discussion paper deals with is determining which rules apply to commercial insurance. The handbook doesn't have a consistent definition to distinguish between SME customers and larger commercial customers. So for the purposes of the FCA's insurance rules, a commercial customer is treated differently to a consumer where it's participating in a contract of large risks. So it currently focuses on the insurance being sought rather than the characteristics of the person who's taking out the insurance. And the original discussion paper sought views on whether the large risks definition continued to be the most appropriate for the purposes of the rules. So whilst the paper originally closed in September, as I mentioned, some of the questions have been reopened to allow respondents more time to provide estimations of the impact of the proposals. So the reopened questions relate to information to help the FCA quantify the costs associated with these challenges, estimates of the expected financial impact of the changes, information on outcomes for commercial customers of different sizes, any unintended consequences the respondents see, and any further information which may help the FCA assess the impact. And there were some more questions relating to co-manufacturers specifically, so where multiple firms are responsible for manufacturing the insurance products, which have also been reopened. And the reopened questions do have a similar focus. Again, it's providing information on the proportion of business which is co-manufactured, the financial impact, the potential options, whether the changes should be extended to any pure protection insurance business for commercial customers, and the financial impact of taking forward the changes. So these reopened questions will remain live until 10th of January 2025. So if you're interested, do go take a look at the reopened questions in the discussion paper. Once the responses are received, the regulator will consider all feedback and hopefully we'll get an update later in 2025. And so with that, I will now hand you over to Jake to discuss vulnerable customers.
Thanks, Lorna. Just a very quick introduction. My name's Jake, and I'm a solicitor within the financial services regulatory team here. So, as Lorna said, I'll be covering the review of firms' treatment of vulnerable customers. So this was initially announced in March of this year, and the intention is for this to be a multi-firm cross-sector review of firms' treatment of vulnerable customers. So under the FCA's guidance, there's a number of factors that are considered in determining whether a customer is deemed as vulnerable. And these fall into 4 drivers of vulnerability according to the FCA. So these are health, life events, resilience, and capability. And things such as like a customer's age are considered in respect of whether they are going to be deemed as a vulnerable customer. So the review itself, from what we know so far, is going to be looking at how well or poorly firms are understanding customer needs, the skills and the capability of their staff, the financial products and services themselves that the firms are offering, and how firms are communicating with their customers. So these are going to be assessed to see whether they are in support of fair treatment of customers that are in vulnerable circumstances. So as well as the inputs that I was just discussing there, they're also going to be looking at the outcomes to vulnerable customers and what they're receiving here. And really what they're going to be looking for is whether these outcomes are for vulnerable customers are as good as the outcomes for non-vulnerable customers. So this is underway, and the intention for the FCA is once they've compiled their findings, is that they're going to share this in a review that they're setting out in Q1 of 2025 of this year. So unfortunately, we don't have a crystal ball. So until that is published, we're not really able to shed much light on what their findings are going to be and what the kind of next steps are going to be. But as you've seen, this is effectively in some corners being described as a fifth outcome of the FCA's consumer duty, that they're really what they're looking for from firms. So it'll be an interesting one to see how this kind of progresses from there. And then moving on to the next topic that I was going to speak about is the financial services compensation schemes, the deposit limit. So every 5 years, the PRA are required to review this. So what this scheme effectively is it protects customers' deposits that are held in authorised banks, building societies and credit unions in the UK. And what the current regime guarantees that if any of these financial institutions fail, then customers who hold deposits in the institution will not lose their money up to an upper limit of £85,000, £170,000 in the case of joint accounts. And this was an increase from the previous limit that was in the last review of 2019, which was at the time £50,000 per person per firm. So again, unfortunately, we don't have a crystal ball, so we're not entirely sure what the outcome of this is going to be. But we know that the PRA are expecting to publish a consultation paper on this topic in Q1 of 2025. But in terms of looking back and things that they're probably likely to consider going by previous reviews, a driving factor as to why there was an increase in the last review was that there was an increase in the amount of claims that were actually exceeding the maximum limit for a claim, which was a driving factor in the regulator increasing the limit to ensure that more claims were fully compensated than would be in the lower limit. So of course remains to be seen what the statistics are going to look like in this current review, as if it's the case that the percentage of claims again is exceeding the maximum limit, that's going to be something that they're going to look at. But a further factor they're likely to consider is feedback from the firms themselves, who highlighted that increasing the limit can increase costs, and particularly the cost of PI cover. So it's another aspect that the regulator is likely to look at. But come the kind of end of 2025, obviously that this will need to be in place. So they're likely to move this through quite quickly in terms following on from this consultation consultation that's going to happen in the beginning of 2025. So that is all to me, and I'm going to pass back now to Lorna.
Thanks, Jake. So the last two topics, I will quickly canter through them both. You can see them highlighted there on the slide. The first one is the Pure Protection Market Study. So the FCA announced in August that they intended to launch a market study into how pure protection insurance products are sold, following concerns that competition is not working well in the market. Whilst the initial announcement suggested that the study could have been launched this year, the Regulatory Initiatives Grid confirmed it will now be into 2025. One of the key concerns around pure protection products is that the design of commission arrangements may not allow firms to deliver good outcomes to policyholders under Consumer Duty. The FCA is also concerned that policy itself may not provide good value where the total premiums paid far exceed the maximum possible payout. And again, it's a little bit of a crystal ball on this one because we haven't seen any study paperwork yet, but proposed terms of reference for the study were published in August, which the FCA has previously invited views on. So we know that the study will focus primarily on the sale of 4 specific types of products: term assurance, critical illness cover, income protection insurance, and whole of life insurance, including policies for over 50s that offer guaranteed acceptance. And it does confirm that insurance products that have a savings or investment element are out of scope. And the study intends to explore consumer needs, engagement and understanding, competitive constraints on insurers and intermediaries, commission incentives and potential conflicts of interest, and firms' behaviour and practices. So I think this will be a really interesting one when it comes out, and I know there will be a lot of businesses following that one very closely, and that will come at some point in 2025. And then the final point I wanted to touch on today is the FSCS general insurance limit. So the PRA published a discussion paper in November 2023, actually, seeking feedback on the limits for general insurance products. So currently, the FSCS provides 90% or 100% coverage of valid claims under insurance products, insurance policies, with the level of protection depending on the type of insurance. And they're now exploring the possibility of increasing coverage for certain general insurance products to align with the PRA's objective of ensuring an appropriate degree of policyholder protection. And they sought feedback on the changes. So very, very briefly, one of the points they're considering is reevaluating the definition of a small business. So again, this is a similar point to the wider study on commercial, or the wider paper on commercial insurance market. You know, when are these commercial insurance rules going to apply? And the PRA outlines a number of possible approaches to sort of address the issues that it sees in the market. And the options include moving all general insurance policy types to 100% coverage, 100% coverage only for certain types of products, rule-based discretion for the FSCS to pay out 100% based on specified criteria, implementing a reverse deductible, or maintaining the status quo, so protection at 90% or 100% depending on the product. So the PRA is considering the responses received to the proposals it's had so far and its next steps, and further publication is expected this year, or sorry, not this year, not quite there yet, in 2025. So that's all I was going to say today, and I will hand you back to Caroline to close.
Thank you, Lorna, and particularly well done for managing to squeeze your 2 segments at the end into 4 minutes. So unfortunately, we're not going to have time for questions today. But do get in touch if there's anything that you saw on screen that we didn't cover and that you want us to give you a bit more detail on, or if there was topics that we did discuss and you're looking for some specific queries or clarifications, then please do reach out to us. And we've got lots of things on the go at the moment, loads of insights up on the website. We've got lots of legal alerts that the team regularly posts through LinkedIn or via direct email. So yeah, stay in touch and we will see you soon. Have a great morning.